Here is my choice of the best global index funds that you can buy. And in this video, I'll also explain what an index fund is and the factors that I considered in reaching my choices. Index funds make up a large proportion of my portfolio, and the reason that I like them is that they're simple, low cost, and they take the decision making out of investing. Let me try and explain. And let's pretend that there are hundreds of chocolates in this box and each chocolate represents a company. You could choose one or two companies to invest in, but it would be very difficult to choose the ones that are going to perform the best. Although Snickers is my weakness. By choosing a passive index fund, I get to purchase the box and all the chocolates that are contained within it, meaning that I invest in all the companies at once. This way of investing will put you in the top 5 or 10%, as the majority of active investors fail to beat the market by individual stock picking. Index funds are therefore a good way for those looking to grow wealth over the longer term. Which brings me on to the first of those important factors in considering what fund I should choose. And that first factor is, should I choose a passive or active fund? Active investing is like picking those individual chocolates in your box and involves prior and ongoing analysis of the companies of choice. It also includes more work and analysis on any other company that you wish to add to your portfolio. And if the fund is an active fund, you end up paying your fund manager higher fees to try and beat a global index. With a passive fund, it just tracks an index, and investing in this way means that you purchase the whole index in similar proportions, meaning that there's less work, less cost, and generally less risk. 10-year returns for sterling-denominated global funds show that on 95% of occasions, active managers fail to beat their passive benchmark, so it makes sense to choose a passive fund, as its returns are far more likely to resemble the index that it tracks, at a much lower cost. So now we've determined that passive would be the style of investing that we will employ, we now need to decide which index we're going to passively track. There are two main global ones, and each of these divide to either include or exclude emerging markets. When comparing past performance between the Morgan Stanley Capital International Index and the FTSE Russell Index, there's very little to choose from, whether you're comparing the whole world versions or the developed markets versions. In the developed world versions, the top 10 companies are very similar and make up about 20% of their respective index. And there's not much difference if you pick the two all-world indices that include emerging markets, as emerging markets only account for about 6% of the whole index. And in all four indexes, the US is the dominant force. Over the past decade or so, developed market indexes have outperformed the whole world indexes that include emerging markets. And emerging markets have been a drag on performance. I wouldn't say there's a great difference between developed world or whole world, but what could be different is the additional fees that you get from investing in emerging markets. The reason for this is that emerging markets are harder to track with less liquid stocks. Emerging markets contain countries such as China and India, so the potential for growth in these regions is massive. But for me, at my age, I have to ask myself the question of when this potential will be realised for the higher fees and lower performance that will be generated. I think if you're younger, then whole world indexes that include emerging markets will be a consideration for you, as over a longer period there's a good chance that emerging markets will become developed markets. My final choices will show funds with and without emerging markets so that you can decide what's best for you. The next consideration is whether you choose a fund which is accumulating or income. This will come down to your personal preferences and investing objectives. Income funds will pay you dividends, and you can then use these as income if that's what you require. If using a general investing account, with no tax wrapper that an ISA or a pension might provide, income funds might be useful, as it will then separate dividends and make it easier for tax accounting purposes. My preference is an accumulation version of a fund, as any dividends are then automatically paid back into the fund without me having to do anything. This is probably more efficient than having to pay the dividends back in manually, which is what you'd have to do with an income version of the fund. Providers often offer both accumulation and income version of their funds, and most of the funds that I feature later on have an accumulation and income version. The next consideration is to check that your fund is sterling denominated, or denominated in the currency of your home country if you live outside of the UK. You cannot completely escape foreign exchange fees, as your global fund will consist of countries from various regions trading in their own currencies. But if you choose a fund that is home country denominated, you can reduce the expensive cost of currency conversion that your investment platform might charge, and this will depend on what platform you use. For example, it can be expensive on some platforms to convert your home currency into dollars to purchase a US denominated fund, and vice versa if you live in the US looking to purchase a fund from outside your country. A home currency denominated fund means that the fund manager is able to convert currency a lot cheaper than us. Well, I do hope that you're enjoying this video so far, and if so, then please consider hitting the like button, subscribing to my channel, and to turn on notifications so that you'd be aware of when I post new content. Sticking with the subject of costs, the next consideration is how we can keep our fees low. There are a lot of things that you can't control with investing, but fees should not be one of them. Fees can really eat into your returns over time. For example, £100,000 invested over 20 years with 0.25% fees would give you a total of £210,000. But if you were to change those fees to being 1%, then that would reduce your total by £30,000, a reduction of 40% in your portfolio. And there are two main things to look out for when trying to keep costs low. The first is to check the fees that your investment platform charges you for holding investments with them. And the second is to check the ongoing charge figure or the total expense ratio that your fund manager charges for administering the fund. And taking these two things into account, you should then consider whether to compare funds with the lowest OCF or TER, and to then check availability on the lowest cost platform, or to choose a platform with the lowest cost overall and then check whether your fund is available on it, and having a second or third choice in hand in case it isn't. On doing your research, you might find there's a lack of availability of certain funds on certain platforms, or that there might be additional costs for platforms holding certain funds. And there are two types of fund that we're going to be looking at in this video. The first is mutual funds, or open-ended investing companies, also known as OICs. And the second are exchange-traded funds, known as ETFs. There are certain platforms that only offer their own funds or ETFs, such as Vanguard, and there are other platforms that only offer ETFs, such as InvestEngine. Your choice of fund could influence which platform you have to hold them on, which could attract higher fees. An example of this would be to look at Hargreaves Lansdown charges for mutual funds. If you were to hold a mutual fund or OIC with them, then you would be charged 0.45% per annum up to £250,000. This means that if you did hold a mutual fund valued at £250,000, then the cost per annum for holding it on that platform would be £1,125. There's not necessarily any distinction between mutual funds and ETFs on the other platforms out there, but you will find there's less availability of mutual funds if you move away from Hargreaves Lansdown or Vanguard's investment platforms. The providers that offer the lowest platform fees are generally the ones that just offer ETFs. A lesser factor, but still a consideration, is to check whether your investment platform allows you to purchase partial shares. This could be useful if you want to ensure that all your spare cash remains invested rather than sitting in your cash account waiting for enough funds to be deposited to purchase a whole share. And this spare cash could come from dividends paid, so having the accumulation version of the fund would solve that problem. And it is often the case that shares in ETFs have to be purchased whole, but investment platforms such as InvestEngine and Trading212 allow you to purchase fractional shares. If your choice is a global mutual fund, then it's more likely that your provider will allow you to buy partial shares, but minimum purchase levels will apply. Before you press the buy or deal button on your choice of fund, it might be worth doing one more bit of due diligence to make sure that your global fund of choice is definitely a passive one, and to check its structure to see if it's a mutual or ETF. This information can often be found on the front page of the fund or as an attachment in the KIID document. The objective section of that document should tell you what you need to know, and there are other sections that will give you the ongoing charge figure and total expense ratio along with the risk profile. So what global funds have I shortlisted using this criteria? Well, before giving you my list, I need to remind you that these are my choices from my own research, and they may not be suitable for you in your given circumstances. I'm not a financial advisor, and what I say on this channel is my opinion and should not be construed to be financial advice. If you are unsure about anything, then please seek the advice of a suitably qualified professional. So if choosing a mutual fund or an OIC, then the cheapest that includes emerging markets is the HSBC FTSE All World Fund. This is available as accumulation and income and is sterling denominated. The ongoing charge figure, having in mind that emerging markets is included, is a very low 0.12%. This means that for every £10,000 you have invested, it'll cost you £12 per year to hold that fund. It is a passive fund and has a risk factor of 5. And equity funds will generally carry risk factors of 5 and above. Its average annual performance over the last 5 years has been 9.82%. The issue with this fund is that as it's a mutual fund or OIC, there's less availability and you might have to pay more to hold it on an investment platform. If you're looking at ETFs that include emerging markets, then the Invesco FTSE All World UKIS ETF, ticker symbol FWRG, is a good choice for me. This also comes with an option of an income version and is sterling denominated. This is the cheapest ETF I could find with emerging markets included, and it has an OCF or TER of 0.15%. This means that for every £10,000 you invest in this fund, the fund manager will charge you £15 per annum. It is a passive fund, and the risk profile is 6, which is higher than the HSBC fund that we just mentioned. There is no 5-year data with this fund, as its inception was in July 2023. This ETF can be purchased on both Trading 212 and Invest Engine, meaning that you can get this with low platform fees. Therefore, the total fee that you will pay for holding this fund on the platform will be the ongoing charge figure of 0.15%. My issue with this one is that the fund doesn't really have a track record, is less established, but it does come from Invesco, who are a well-established company. So moving on to funds that exclude emerging markets, and maybe you might find that these funds work for you as an older investor. The pick for me has to be the Vanguard Developed World ETF with an accumulation version ticker of VHVG. And this fund on this occasion tracks the FTSE Developed World Index as opposed to the FTSE All World Index that the two previous ones did. Again, it's sterling denominated, and there is an income version if that's what you prefer. Income versions of funds come with different ticker symbols to identify them. With this one, the ticker symbol is VEVE. Whether the income or accumulation version, this fund is available widely, but can also be purchased on the Vanguard site if that's what you prefer. But in those circumstances, you would have to add the relatively low Vanguard platform fee of 0.15% to your OCF. To save that platform fee, you can also find this fund on Trading 212 and Invest Engine. Again, if investing £10,000 in this fund, the ongoing charge figure of 0.12% will mean that you pay £12 per annum. This fund is a passive fund and has a risk profile of 6, and the average performance return over the last 4 years, which is the maximum we can go back with this fund, is 10.75%. As an older investor who does not have time to wait for emerging markets to become developed markets, I think this is a good choice for me. We mentioned earlier that emerging markets has been a drag on performance over the last decade or so. Therefore, emerging markets FOMO is not something I'm worried about. However, you do still have the option to purchase an emerging market fund separately and add it as a smaller proportion to your portfolio. Adding it in a smaller percentage like this means that you keep the OCF and TER costs lower. And an alternative to the Vanguard Developed World Fund would be the Fidelity Index World Fund. This one tracks the MSCI index, is accumulation, is sterling denominated, and has the same ongoing charge figure as the Developed World Vanguard Fund of 0.12%. And this one has a lower risk factor of 5. So if you don't particularly like Vanguard, then this one might be a good alternative for you. Well, there are 4 options for you to take a look at, 2 including emerging markets and 2 from the developed world. I hope this has been useful for you in helping you shortlist some global funds for you to choose from. If you prefer Vanguard as your choice provider, this next video will show you 7 of the best Vanguard funds that are available. Once again, thanks very much for watching.